Welcome back to Trading 360. I'm Diane King Hall, live from the floor of the New York Stock Exchange. Time now to spotlight sector positioning, and we'll call some attention to tax reform. Joining us now for perspective is Tony Drake, CFP at Drake and Associates. Tony, thank you so much for joining us. Before we get into your views on sector positioning, I'm curious to know your market outlook, given that you describe the current environment as a late cycle economy showing signs of deceleration, yet we continue to see records in the market. What do you make of that disconnect?
Yeah, I think we're all seeing that disconnect, right? And there's certainly some signs of that late market cycle, but you got to be careful here, right? I think that the game here right now is bridging between growth and kind of paring back a little bit to protect yourself. We just don't know what the timing's going to be. We're going to see what happens, when the Feds cut these rates. And, I think the challenge from a larger perspective is the country's debt too, and how are we going to save America when the spending seems to continue? We got this tax bill through, but there's also some new spending there. We've all seen the spats between Elon and President Trump, and a lot to be left on the table there. And I guess we'll see how that plays out in the second half of this year.
So what are you expecting in terms of the impact of that bill, that big, beautiful bill? Obviously, Wall Street seemed to celebrate it. What's the view from Main Street?
Yeah, I think from Main Street, again, a lot of people are just looking at this debt. Can we save America without having to print money, essentially inflating away the debt? And when you look at Bassett, he's shooting for these kind of 3-3-3 guidelines, right? He wants 3% debt to GDP. That's 6 now, so we're going to have to cut it in half. It's got a little room on inflation, looking for that 3% target, and we're at 2.4, and GDP growth at 3%. We're half that now, right? So are the tax cuts and this kind of boom in AI, is that going to increase GDP growth enough? I think the jury's out. We have to find out. Is the tariff revenue, is that going to increase GDP growth and kind of dig us out of this problem? I think the jury's out there as well, right? I think the Feds are probably going to cut rates, but that's going to tick up our inflation. So there are some warning signs there, I think, and maybe that was inherently the problem with DOGE. We just haven't had a fundamental shift in spending in Washington, and I think that hits middle of America. So certainly some nice benefits with the tax rates that were set to expire at the end of this year. Those are going to now be extended. That's going to be great for middle of America. So I think that we'll see some benefits there. But, we really have to figure out what we're going to do with this debt short of inflation and raising taxes.
Tony, I'm curious to know your views on sector positioning now. You say the goal is balance between growth and stability. Obviously, tech has been booming, and it's all about AI in terms of that. But can you unpack what you mean when you're, kind of in practical terms, when you're talking about pursuing balance?
Yeah, I think for investors, they really want to think about asset classes and maybe even regions of investments that thrive in maybe later, cycle markets. I think value over growth can sometimes help in these areas, and maybe income over speculation. There's a lot of internationally developed markets that offer margin of safety with some great valuations right now. We also work with a lot of retirees, so different time frame for them. So I really want retirees to stay vigilant with cash flow planning. Don't let these recent market highs tempt you into chasing those returns. That can really sting us in retirement. So you want to use this momentum to reassess bond ladders, adjust for potential Fed cuts. Could be some good, interest rate opportunities right now. The economy isn't falling off a cliff, but it's slowing just enough that I think the Fed is on a razor's edge and is likely to make some adjustments there. And that's why we really want to balance between that growth and stability.
So, Tony, I want to ask you this, not for actual retirees, but for those who say maybe 10 years out, or even, let's say, 10 to 15 years out. Do you still suggest this barbell approach? You talk about pairing sectors like tech with defensives. How should investors think about that mix if they've got 10 to 15 years?
Yeah, if you have some time on your side, I think this is a decent time to take a little bit more risk. I mean, we all saw what happened with NVIDIA yesterday, and, tech sectors and AI continue to soar, especially on some of these tax tailwinds. And, but when you look at some more traditional safe havens like healthcare, consumer staples, a little bit more uncertain, right? I mean, technology, is definitely benefiting from some of these tax treatments, right? Bonus depreciation is back. I mean, massive change with R&D expenses. not just this year, but being able to retroactively go back and treat that as an expense. That's a big deal for these technology companies that have these massive R&D budgets, and that can really benefit them. So you want to be selective with the sectors, but if time's on your side, remember, we really favor a long-term investment plan. Trying to time, get in and out generally doesn't work. So it's about waiting to the right areas and really seeing what's going to benefit from these tax bills and where we are economically.
I'm curious, I want to go back to the point you made about retirees and not chasing returns. While that is very logical, sometimes emotion can come into play. You often have that FOMO feeling. What's the advice to kind of protect against that, or for retirees to say stress test their portfolios?
Yeah, I would tell you as a CFP that works with, kind of retail America when it comes to investing in retirees, psychologically, that's the most challenging part, right? When we look at the data historically, you're kind of do-it-yourself at home investors tend to buy at the wrong times. They sell at the wrong times because emotion gets involved. So for the retirees, I think sticking with sectors that offer dependable dividends and pricing power is really key here. You might, utilities and healthcare may lack the flash, but I think there's some opportunities there. Want to be a little careful with healthcare with some of the changes here in the latest tax bill, but they can offer a peace of mind when the economic picture isn't looking so great. And when you're in this kind of dual personality market, you don't want to pick sides, but you brought it up earlier. We really want to bridge that gap between growth and safety. And for retirees, it's really about the long-term picture, making sure that income's going to be there. This isn't the chapter of life where we need to hit home runs. Singles and doubles work really well in retirement.
That's a fair point, especially when you think about retirement. But great perspective there about obviously what you're dealing with is sometimes just emotions around this. All right. Thank you so much, Tony. We appreciate your time. That's Tony Drake, CFP at Drake and Associates.